Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul teaches Aaron what it means when the VIX is over 30, and things get a little wonky, explaining all the technical math behind stock market volatility. They appropriately compare options to insurance and gambling. And they discuss the Black-Scholes pricing model and how market forces determine implied volatility. In the end, they discuss how understanding the VIX can be a useful tool, but trying to rely on it for investment predictions can be just as dangerous as any other future prediction methodology. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron. Good to be here today. How are you doing?
I'm doing well. I'm excited for our conversation today. So, as we got ready for our conversation last week, where we were talking about our feelings and emotions as market was going up and down, we kind of detailed some of the big swings. Trishul made a quick comment that the VIX was over 30. And my first reaction was, I know what the VIX is, but I have no idea what over 30 means. I mean, the way he said it, I think it sounds high, but I had no context for what he was talking about. And I realized it was actually a similar feeling to when I see headlines and says the Dow is down 1,000. And off the top of my head, I don't know what the Dow was at to start with. I'm pretty sure it's in the 20s or 30,000 range, but I had no context for what that meant. So today, I'm going to let Trishul teach me about the VIX and volatility and some of these other more technical measures and ask him lots of questions, because this is where his bread and butter, this is where he really established his experiences. So, Trishul, for someone who knows that the VIX means volatility, but not much else, how would you describe the VIX and or volatility?
Sure. So one way to think about it is, and you may have even heard this, it's the fear gauge of the market. Kind of like a barometer. It's telling you how fearful are people right now. So without even putting numbers to it explicitly, what you can think of is if the fear gauge is low, people are calm, and when the fear gauge is high, people are nervous. So that's the simplest way to think about it. When things get more volatile, they get more scary. When things get less volatile, they get calmer. So without even adding numbers, that's a way to think about this notion of volatility as it relates to the markets.
Okay, so one of the questions I want you to get to is, I thought volatility could be high even if the market is consistently up. But I want you to first, what does over 30 mean?
Okay, so now let's get into some of the details. When we talk about the VIX itself, it is a measure of the volatility. And on average, let's just put an average point, it's around like 15 to 20.
Okay.
Now, what that means is what the market expects for the S&P specifically, that's what the VIX is tied to, is that the VIX should move up and down with a range of plus minus 15 or 20 over the next year.
If the VIX is 15, you're expecting the S&P 500 to be up or down 15% within the next year.
Yeah.
Okay.
Now, there's tons of nuances to that, and we don't want to cover all of them because it gets really nitty gritty. But that's a high level notion, and that gives you a little bit of an insight into what the market is thinking when it goes from 15 to 30.
It's that we have less confidence, more fear. It could be up 30, could be down 30 over the next 10. Like that's the today's expectations.
Right.
For the range of possibilities over the next year.
Right. So if you have $100 now, when it's at 15, you might be between $85 and $1.15 over the next year. But if the VIX is at 30, well, now you could be between 70 and $1.30. There's a larger disbursement of possibilities with a higher VIX,
Okay.
meaning more uncertainty on where we could end up.
Okay.
Now, I don't want to get too technical, but more specifically, the VIX is a 30-day estimate of what this volatility should be, but that 30-day estimate is annualized.
Okay. Okay. So okay. I understand that. It's we're taking very roughly 1/12. So if it was this again, all oversimplifying the math, if the VIX was 12, then we expect it to be, it's an annualized number over the next 12 months. We kind of expect it to be up or down 1% in the next month, in the next 30 days.
There's a little bit of nuance. You don't actually divide by 12, you divide by the square root of 12. That's just how the math works with volatility.
Okay.
So you divide by 3.4.
Well, I was trying to think of like how to explain annualized returns. So
right. So with returns, yeah, you divide by 12. With volatilities, you divide by the square root of 12.
Okay. Okay.
Without getting too technical,
It's okay.
It just turns out there's a square root in there in the math.
Okay. So this might. Okay. Now I'm going down the technical path because I'm genuinely curious, and this fits my math background. Is this a standard deviation measure on a bell curve?
Yeah, it is. That's the neat part. So when you think about volatility, you can actually calculate it. And the formula is your standard deviation formula.
Okay, so the VIX is measuring one standard deviation, or is it a little higher out?
It's one standard deviation. So here's a way to think about it. If you take the returns of the S&P for the last 30 days,
okay,
and you take the standard deviation of those returns,
okay,
and then you annualize it, you'll get a measure of what is known as historical volatility.
Okay. Okay, so that's the looking back over the last 30 days. And for more context, one standard deviation in the bell curve only encompasses about 2/3 of the total possibilities.
Right.
To get out to, I think it's a 95 or 99% interval, you have to go out to 3 standard deviations.
Right. So exactly, the 2 standard deviations around 95%, 99 around 3. So
okay.
the notion is most of the time you'll be within 1 standard dev, and most of the time you'll be within 2, and then you'll very likely be within 3.
Okay. So again, I actually have a math degree, and I've never heard anyone say standard dev or dev. That sounds like you've been using that word so often that the extra 2 syllables were frustrating to say over and over.
Right. Or in the industry, we call it vol, VOL.
Okay.
Vol.
Okay. Okay. So if the VIX is at 15, we can kind of interpret that as the current market's expecting there's a 2/3 chance that it's going to be between $100 is going to be between 85 and 115. And there's a 95% chance that $100 will be between 70 and 130. And it kind of that gives us our range. And so when VIX goes up to 30, now our $100 our like 95% range of possibilities is $40 to 160.
Right. And people aren't really concerned about that 160. They're a lot more concerned about that 30.
Okay, so when
which
VIX
is why
is up
people
to
get worried when the VIX goes up.
Okay, so VIX is up to 30. There's a realistic possibility, not likely, but it's in the kind of realistic realm of possibilities of seeing a -60 over the next year.
Something like that. And here's the interesting part. So we just detailed how you might calculate this notion of historical volatility. It's just a mathematical formula, standard dev, and you plug in the returns and it'll tell you what it is.
Okay.
Now that's the last 30 days, but who cares, right? You care about the next 30 days. So then the question comes down to, okay, well, how do we figure out what the volatility is going to be for the next 30 days? It hasn't happened yet. Well, the very interesting part is you can figure that out mathematically by looking at option prices.
Okay.
Now, here's where things get a little bit interesting, but I'll try to, again, keep it high level. So in option, you've heard of calls and puts. The very simplest way I like to think about options is they're a form of insurance. So we all know about the put, hopefully.
So I'm going to say I've never thought of it as insurance, although I see exactly how it is. I've always thought of it as a forward bet where, yes, I use covered calls as a better example, where if you own a stock and the owner of the call is the right to buy. So if I sell a call, someone else has the right to buy. But if I put it above the current stock price of my stock, then I can collect money on the premium from that call. And the only way it gets called away is if my stock went up. So, and I just realized that was way too simplified and not going to help anyone actually. So we might have a deeper conversation on options later, or never, because I don't know too many clients who are going to be investing in options.
Maybe. The words get thrown around here and there, and the math does get complicated at times, but the notion can be pretty simple.
Okay, so as insurance.
Yes, here's a way to think about it from an insurance perspective. If you're nervous about the stock market going down, what you might do is you might buy a put.
The right to sell.
So when you buy a put, what basically happens is you pay a little bit of money, meaning you buy some insurance, you pay some premium, and if the market goes down, you get paid a lot more money.
You've locked in your higher selling price.
Yeah, technically. But more specifically, all you did is you paid a little bit of money, and when something bad happened, you got paid a lot of money.
Okay.
Just like insurance on your house. You pay a little bit of money in terms of a premium, and if the house burns down, you get a lot of money back.
Okay.
That's what you can think about in terms of a put. It's market crashing insurance.
Okay.
Now, let's think about a call. A call is the same thing, but it's going up insurance. You pay a little bit of money, and if the market goes up, you get a ton of money.
Yes.
Another
right
way
to buy. I own the right to buy at a low price.
Exactly. Another way to think about a call is it's like a lottery ticket, like you said. If you buy a lottery ticket for a little and the right things happen, you get a lot of money. So very simply, you can think about a put as going down insurance and as a call as going up insurance.
If you're buying the put or buying the call.
If you're buying, if you're paying for it. And then the other side of the equation is the sellers, right?
Yeah.
I can sell insurance too. I can sell a put, meaning I collect money now.
Yep.
And if something bad happens, now I got to pay a ton.
Yes.
And then the same thing with the call. So that's probably the simplest way I can think to explain options and calls and puts and whatnot. But hopefully that makes sense so far.
Okay, so I like that phrasing of the selling side feels a little bit like the picking up pennies in front of the steamroller analogy, where you're going to make you're making a little bit of money each time, and as long as you don't get caught, you'll be fine. But as soon as you get caught, it's devastating. It's catastrophic. And if you're buying them, it's more like that, the gambling side, but you have really good odds. So it's not likely to happen, but it's the long shot bet at the racetrack where you keep betting this 30-1, and you'll probably have more losses over time until one of them pays off big and can cover all those other little losses.
Right. Now just think about this for a second. If you want to play in this game, would you rather be the insurance company or the gambler?
That's a great question. I think that's what goes back to our conversation about buying stocks for fun a long time ago. It's the insurance company is like being the house in a casino. Like, you're gonna you have your 1% edge over a long enough time, so you need a really large sample size for it to kind of play out. But if you're doing it on a smaller sample size and just taking bets and having fun with it, then yeah, I'd rather be the gambler.
So here's how the math kind of works with options in general. If you're the insurance company, you get to sell these options and you collect these little bits of premium. And then, as you had mentioned, if something bad happens, now you got to pay a lot of money. But the way an insurance company manages risk is they don't sell options, in just one market. They sell them all over the place. So they spread their bets out. And on average, if one area is doing bad, another area is doing good, you kind of do okay. And you can make a good amount of income if you manage your risk correctly. So if you're a good casino, that's what you do as well. You
Yep.
manage your risk across many different bets. All of these different lottery tickets all over.
So the insurance company or the people selling options, if they're going to make money, they're selling both puts and calls.
Right.
And trying to kind of make enough money on the premiums for one of the side that ends up paying out.
Right.
Kind of like how a sports book, they have all they're trying to do is collect their VIG.
Yep.
The vigorish is the kind of the difference in odds between one side or the other, where their goal is to have just as many bettors on one side as the other, and they're going to collect their 5 to 10% from either side.
Exactly. You've probably heard this phrase, the house always wins. So that's how these markets kind of work. And this was actually my previous life before the hedge fund. I used to make markets and options and selling these types of products across dozens of different markets. And the way it worked is when we were small and we had a few markets, we used to have pretty large swings here and there. But once we grew to a certain size, we had spread our risks out to such a point where it turned into, frankly, a money-making machine where you just sell all of these different types of basically transactions or trades or bets, and the risk seems to mitigate over time, especially if you spread out enough of your risk across all these different markets. So it's a pretty good business, and that's kind of how it works. Now, the flip side is to be the buyer. Now, think about that gambling analogy. What happens to the people who gamble the more they gamble?
The more they gamble, the more likely they are to lose.
Right. So if you want to make money buying options, you have two things on your side. One, a quick win, or two, just somehow being lucky in the long term.
Okay.
So it's basically a negative expectation or a losing proposition, to be honest, if you want to keep doing it a lot.
Okay.
But if there are certain periods of time where you feel like you can't take the risk, it may be worth it to buy an option.
Okay.
So that's one example of where if you're worried about the market falling over the next week or so, you might go out and buy a put on the market.
So now you're kind of thinking in terms of hedging, where
if you're
most
trying
of my
to
money,
hedge.
I own stocks, I own a diversified portfolio. So most of my money, I will make money if the market goes up. So I will buy a little bit of insurance in case the market goes down. I'm still going to lose a lot more from my regular portfolio, but I won't lose as much because I'm making money on the puts.
Right. And that's why people might go out and buy these types of insurance products or this type of protection if they're trying to mitigate against risk. And what I might say to that is it might make sense in the short term, but if you keep doing it enough in the long term, you'll probably end up losing more than you can make just because of how that situation works where you're the gambler and the casino is slowly taking away your winnings.
Yeah. So if I have a long stock portfolio and I just want to see, I'm holding it long term, just want to see it go up, and I keep trying to buy puts to protect against some downside, over the length of that portfolio, much more likely that just the costs of those puts just eat away my returns.
Right.
So it's less likely that I'm actually going to pay out, and over a long enough time frame, the payout won't be big enough to make up for paying those premiums each year along the way.
Exactly. And this is something we can get into probably in another episode, but just the notion of insurance and long-term strategies and self-insurance and things like that, it's worth getting into, but it's probably for another topic or another day.
I agree. And I think that we can probably go into life insurance, disability insurance, long-term care, homeowners car, like, yeah, that idea of insurance and when it's necessary and when the cost isn't worth it. So I like that idea of a future episode.
Right.
Okay.
So,
So now,
yep.
what do options have to do with the VIX?
Okay, so here's the nifty thing. There's this equation called the Black-Scholes equation. You may have heard of it.
Yes.
It
The
was
Black-Scholes option pricing model.
Yes, it was this pretty nifty equation because before that, people actually traded options, but they had no idea how to come up with the price. For example, or they had some idea, but it wasn't as specific. For example, if I want protection that pays out if the market drops 10%, how much do I pay for that? $1, $10? Who knows? Well, you can let the market decide, and the markets will basically come up with a price that makes sense because the participants are having a public auction and some people are saying, I think it's worth $5, I think it's worth $7, and so on. And slowly they gravitate towards a price and a sale happens and a contract gets created out of thin air. So that's how prices used to work. But then there was a bunch of research by 3 players, Black-Scholes, and this other dude called Merton, and that they worked on the specific line of research where they realized you could come up with a price for an option just by using a few key inputs, 5 numbers. And with 5 numbers, you could figure out what's the rational price for an option. And in fact, the people who used this formula to come up with a price initially figured out that their prices were much better than the people guessing in the market.
Yeah.
And they were able to make a good amount of profit.
So I'm going to try and guess this. Let's say current price, expected return, expected volatility, time frame, and what could be the 5th one? Okay, I'm not going to get it. You know it?
Well, so you need a target or a strike price, basically. What price will the options start paying
I
out?
see. Okay. Oh, yeah. Okay. Because there's a difference. Okay, I see. Yep. All of those could describe an option that has if it's for a $100 stock price, the option could be at 90, the option could be at 80, and those other 4 variables didn't affect. Okay, I see. Yep, I got you.
Right. Yeah. So very quickly, let's say IBM is trading at $100, and you want to buy an option, a put that starts paying out if IBM drops below $90.
Okay.
Well, in that case, you need a few things. You need the current price, $100.
Yep.
You need that price where it starts to pay out, the $90. You also need how long this option is in play for. 1 year, 2 years, 1 month, 2 months, and so on. Let's say 30 days.
Okay.
And then you also need the rates in terms of the dividends you might get and the interest rates in effect for these 30 days.
Oh, I forgot that too. Yeah. Okay.
And the last thing you need is how volatile you expect IBM to be for the next 30 days. Now, the interesting part is 4 out of those 5 numbers are pretty well known.
Yeah.
It's that volatility that's a tricky part. Now, we can guess on that volatility and the market can guess, but basically what Black-Scholes, Merton figured out is if you can get a good estimate on that volatility, you can figure out what an option price is, and you can probably beat out the other players in the market to sell options at a better price, at a cheaper price, and control the market, or avoid options if they're too expensive.
Okay.
So, they won the Nobel Prize for this work, and it was great, and it led through an explosion of options in the markets. And the interesting part is now the option prices in the market start to make sense. And here's the other interesting part. Now that people are coming up with better prices for options, you can take the Black-Scholes equation and take the inverse of that equation such that if you have the market prices, you can figure out what the volatility is that the options are predicting.
Okay.
If that makes sense. So
Yes.
you can extract this volatility number from the market prices of options.
Okay.
So interestingly enough, if you extract the right option prices you can figure out what the expected volatility is for the S&P for the next 30 days from
Okay.
option prices, and that's your VIX.
Okay. So VIX is, I guess, indirectly determined by market prices of options over a next few time frame, or actually probably a combination of different time frames.
Right. So the VIX is a 30-day measure of volatility. So when you pull volatility from option prices, the technical term is implied volatility.
Okay.
It's implied from the option prices. And there is no exactly 30-day option. You know, there's like a 28-day and there's
Yeah.
a 36-day because they have fixed
It's specific
expiries.
dates. Yeah.
So it's like a weighted average of these calls and puts.
Okay.
And there's a exact formula for this, but that's the high level notion. You can get a 30-day estimate from the market of what the market thinks volatility will be for the S&P.
Okay.
And that's the VIX.
Okay. So when current stock price is 100, but more and more people are buying that $90 put because more and more people think the stock price is going below 90, then as all the other variables of that option stay the same, but as the price changes, that implies the volatility is going up. So more people are predicting that the market will go down.
Right. Yeah. So that's at a high level how it works. Now, we did mention that, you know, with a implied volatility of 30, that it could be up 30 or down 30. And not many people care about that up 30 as much as the down 30.
No one's afraid of the market going up 30%.
No, yeah, exactly. So this is basically just because the notion of standard dev happens to look at upside and downside returns when it calculates a standard deviation measure for historical volatility. There are better measures. You may have heard of something called the Sharpe ratio, which
Yep.
looks at the return divided by volatility. So it's like
so this is a risk-adjusted return. I think it's risk of the investment minus the risk-free rate to kind of account for inflation,
right.
divided by the standard deviation.
Right. So that vol measure. So basically, the higher the risk-adjusted return, the more favorable. But
Because it can
again,
be either expected return is going up or standard deviation and volatility is going down.
right.
Or some combination of both.
Right. Now, if the standard deviation goes up, meaning the volatility goes up or the VIX goes up, that means your expected Sharpe ratio goes down.
Okay.
Right. And just a nuance is people realize that standard deviation measure was looking at positive returns and negative returns. So some smart dude said, how about I just get rid of those positive returns? Because all I care about is how variable are those negative returns.
Okay.
So there's a better metric than Sharpe ratio. It's known as the Sortino ratio. And what that basically looks at is the return divided by the downside deviation.
Okay.
Just the deviation of all the negative returns.
Okay.
So that's something to think about if you really aren't worried about upside volatility.
Okay.
But that's a drawback to the VIX measure. It looks at upside returns and downside returns. So that's just one area, and I'll cover a few more of why the VIX is not that helpful at times at capturing this notion of volatility.
Okay. Do you, by any chance, have any examples of VIX being particularly high or low compared to what people think about?
Yeah, so the VIX is an interesting measure. So just stepping back a bit, it's quite neat because, wow, all of a sudden we have a fear gauge, meaning if the VIX is high, the market is more likely to go down in theory, right?
Okay.
So what did people first think when they heard of this? They thought, oh, great. Well, when VIX is high, I'm going to sell my stocks and I'm not going to lose money because look at that. And when VIX gets low, I'm going to hop back in. And people started to come up with various ideas on how to trade this type of instrument. And for the most part, as you might imagine, the markets aren't that easy, and that just ended up being a recipe for disaster. So the concern is that, or the goal was that now that we have a fear gauge, it might give us insight into when or when not we should be invested for the future. But unfortunately, there's just so much noise in that estimate. It really doesn't help to use that as a trading signal on its own.
Okay.
Meaning there will be times when the VIX is elevated, but the markets keep marching up.
Okay.
And there will be times when the VIX is low, when something bad could happen. Because in theory, something bad could happen at any point in time. That's kind of the point of a exogenous event. For example, a terrorist attack can happen at any point when the market is least expecting it. So therefore, the VIX might be oblivious to that fact.
Okay. Okay. So I pulled up the VIX. I've never looked at this, but I did search on Yahoo Finance for VIX, and it looks like most of 2019 it was kind of between 12 and 19, so in that 15 to 20 range you're talking about.
Yeah.
And then we get to that 1 week in February that we talked about last time, around February 19th, and it jumped to 40, and now it's in the 40s, and now it's actually above 50.
Yeah, so the VIX itself has more than doubled. It's gone up more than 3 times from its lows of last year. So that's a 300% change, which means that things are a lot more fearful now than they were before. You'll notice in periods like 2008, the VIX was certainly more elevated than it was during the periods after that. Although there were spikes here and there when bad things happen, the VIX reacts by going up.
Okay.
You'll notice events like Brexit or events like volatility shocks that we've experienced that have caused the VIX to soar. One data point that does stick out is actually February of 2018. So interestingly enough, the VIX had its largest spike in history on February 5th and 6th of that month. And what actually happened there is the market experienced some turbulence, and some of these instruments that trade the VIX ended up getting into a vicious cycle and ended up getting squeezed. And a few of the funds actually exploded on that day, causing the VIX to spike over 100% in a single day.
Oh, wow.
So that was a pretty big event for traders in that space. It was a fun day. And a lot of people lost billions of dollars just because of what happened with the volatility on that particular event. The next biggest crash or spike in the VIX actually happened before the VIX was born in 1987. So that'd be the Black Monday that everybody might know about. And
that's negative 20% in one day.
Yeah, that was a negative 20% for the market in that day, the largest decline in a single day that probably anybody can remember that's alive today. And the VIX didn't exist that day, which is a measure of the implied volatility of the S&P 500.
Yeah.
But there was a proxy to that was around that day, the VIX for the S&P 100. And that's known as a VXO, if you want to check it out. But that instrument spiked not 100%, not 200%, but 300% in one day. So that's your worst case scenario for a VIX-like instrument, 300% change in the day.
Okay, so now that we've kind of talked about what the VIX is, what it measures, I have context for that now. So understanding, like, most of the time it's in the 15 to 20 range, and below 15 would be kind of low volatility. 15 to 20 is probably that average range. So when you said it's over 30, that's already a sign that it's getting significantly higher than normal. when do you look at this often at all?
I used to probably watch it all the time for a good 4 or 5 years straight, probably
Okay.
nonstop. But
Okay.
I used to trade instruments on this, so
Yeah.
it was quite natural for me to do so.
Okay. So when either you now or clients, when we hear headlines about the VIX, or whether it's markets, what are some of the like feelings that you have? Or like it's just more headline news that we can ignore? Is it all short term? How do we think about it when we hear something about it compared to when we hear headline news about the stock market?
Right. This comes down to the so what? Like what do we do with this this number that
Kind
people
of,
care
yeah.
about?
Like, should we even care about this particular number?
Right. I think to begin, let me add a little bit more context. So the interesting distinction between the VIX and something like the Dow, for example, is we began this conversation with the Dow has fallen 1,000 points, for example, recently. What does that even mean? Well, when you think about an instrument like the Dow, it's the measure of a valuation of the market of the 30 largest companies in this case.
Mm-hmm.
Well, when you're thinking about the valuation of companies over time, that goes up, meaning it's sensible for the Dow to keep going up and up as companies get more profitable and they make more money and they grow. But for the VIX is something that doesn't keep going up. It's something that's known as mean reverting, meaning if it goes up, it tends to come back down. It's
Okay.
more like, as I mentioned in the beginning, a barometer. For example, the barometer for humidity, 0 to 100%, if it gets to 90, there's a good chance at some point it's going to go down because humidity doesn't go up and stay up forever.
Okay.
And humidity doesn't go down and stay low forever. So a good thing to think about is in terms of a median case, what to think about in terms of volatility is around 14 to 16 is a good
Okay.
median case. And if you see a number below that, 9, 10, 11, 12, it's more likely to go up. So that's something to think about.
Okay.
And on the low end, the lowest you'll probably see is a number like 9, 8 or 9. We've been seeing those numbers during the height of the bull market over the last 10 years, every now and then. But the other flip side is if the numbers get higher, they're more likely to go down over time because of that mean reversion nature that I talked about. So currently, the vol is in the 30s, 40s, 50s. That's in the top 10% of observations, the top decile of observations.
Okay.
Meaning you should expect it to go down from there over time.
Okay.
Now, I want to answer the so what. Again, as I had mentioned, people had thought this was a great gauge for what they should do in terms of how to invest.
Mm-hmm.
But in all honesty, it's a lot more tricky than that to use this as a signal to time the market. We've mentioned over many episodes why timing the market gets troublesome. So I want to be clear that using this as a gauge for when to get in and get out is probably going to lead to a lot of trading and not necessarily a lot of excess gains.
Okay. Okay. So this is like you can't, if the stock's going down, you can't sell it after the stock is going down, and now it's like once the spike in the VIX happens, the action you could have taken has already happened. Would that be a
Right.
fair?
Yeah, it's that whole notion of postcasting versus forecasting. And it's great to tell you where we are and maybe how we got here. But as far as predicting the future, even though the VIX is calculated from future option prices, from price options that are designed to predict the future, the people who price those options don't know the future either.
Yeah.
So it's not like they have a special edge to figure out when is a good time to buy the option or not, or whether the price of the option is better than it should be or worse than it should be. So the actual volatility itself is the market's best guess, but the market doesn't know the future either.
Okay. I am impressed. I try to throw some complicating questions, but you actually had a really good grasp. You sound like someone who has looked at this and understood it deeply for years on end.
Perhaps. The other thing I'd like to highlight, though, is there are some nifty products on the street that you might come across relating to volatility. So you can actually trade the VIX as an ETF. You can trade the VIX in terms of, if you want to buy protection, there's an instrument called VXX. So this lets you buy short-term protection, kind of like a put, but more specifically on volatility itself on the market. And what this basically means is if the market crashes, the VXX will go up. And if markets are good, the VXX will go down. And if you're looking at that price now, you might see something very interesting if you look at the long-term history of this price.
Okay. So, well, okay, so I'm trying to think, how would an ETF work if it's not expected to go up over time?
Right. So a few things. Not only is this ETF not expected to go up, but we notice with the VIX, it has this mean reverting nature, meaning it tends to cycle around this 14 or 15 number. But with VXX itself, if you look at the stock price, it actually keeps going down and down and down.
Yeah.
It's an investment from one standpoint, but really it's expensive insurance. So the only reason you would buy this is, as I mentioned, in the very short term, if you're concerned about the markets falling, you would buy some of this as a hedge. And if the markets do fall, this will go up and cut your losses lower than what they would have been otherwise.
So are you saying this is like a theoretically similar as buying a put, except I don't need a margin or options account to do it. I can just buy an ETF.
Right. So basically,
theoretically, it with lots of air quotes.
Yeah, with Wall Street, if there's a product that could be made, it'll show up. So this is, in my mind, one of those solutions in search of a problem scenarios. But in theory, you could do this. However, if you read the prospectus for this particular ETF, it actually says in there, the long-term value of your investment is zero. So if you buy and hold this instrument, you can expect to lose a large part or all of your money that you put into it. So there is something you can do if you want downside protection. I highly discourage it, even for the short term, but it's just something that it might be worth our listeners to be aware of.
Okay.
The other thing I would highlight is, since the Wall Street loves creating new products, there's also an inverse to this particular ETF. It used to be called XIV, which is VIX spelled backwards, but
Okay.
you can check that out as well if it still shows up. But this was basically the opposite side of that trade. It takes a short position on volatility, meaning if the markets go down, this particular instrument also goes down.
Okay.
And if the markets go up, this position goes up. Now, this particular instrument has gone up and up a lot until major disruptions happened. And this is one of the instruments that blew up on that February 5th, 6th day in 2018, where volatility spiked over 100%.
Okay.
Because as volatility goes up, this instrument goes down and it went to zero. So basically a ton of people lost money.
It looks like it's no longer in existence anymore.
Yeah, there are cousins of this that are out there, and there's probably a dozen or so ETFs that have spawned since then. But I'd say this is a place to trade that is probably not going away, but definitely want to exercise plenty of caution if you're delving into this space.
Okay. So when you see the VIX is over 30, what comes to mind for you? What's your first gut reaction?
Oh, that's nice.
Okay. Is it like, oh, that's an interesting data point?
I think so. At this point, I've seen a lot of craziness in the markets, and I've seen a lot of changes and a lot of fear that's driven through. But at the end of the day, the concern is, what do you do? And a lot of people have tried to figure out ways to come up with a way to not lose money and to step out of the way of danger. But unfortunately, there's not a great solution to that, meaning the best strategy I've seen so far is that buy and hold, meaning invest for the long term, ride out the turbulence, and if your time horizon is long enough and you can stick to your guns, overall you can expect to be better than you were.
Buy and hold something with a positive expected value like stocks,
Right.
Not buy and hold the VIX.
Certainly don't do that.
Okay. Well, thank you very much for the great education, Trishul. I really appreciate it. Hope that our listeners appreciate that as well.
Thanks, Aaron. And I enjoyed the chat today as well. And of course, thanks everybody for listening. If you enjoyed hearing this podcast, we encourage you to spread the word. Thanks.
Thanks. Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.